Not in generations has Wall Street absorbed the number of body blows it took today.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
When you step back for just a moment, consider the events of the last few days. It is truly unbelievable.
The 2008 crash was the greatest jolt to the global financial system in almost a century. It pushed the world banking system towards the edge of collapse.
In all, the Great Recession led to a loss of more than $2 trillion in global economic growth. It was such a shock to the economic system that it unleashed dynamics that we still do not understand fully. I am Gurmeet, and in this episode, let us get back to 2008, understand the basics about bonds, how do they work, and how did mortgage bonds become the root of all evil, leading to an economic collapse.
What is a bond? Well, a bond, also known as a fixed income security, is a debt instrument generated for the purpose of raising capital. They are essentially loan agreements between the bond issuer and the financier, in which the bond issuer is required to pay a stated amount of money at definite future date.
Since a bond basically represents a source of revenue which is fundamentally based on borrowed money, the Wall Street in the late 1980s decided to create bond-like financial products which were sourced from different income sources, which were based on debt, things like student loan, credit card, and home mortgages.
Thus, a new kind of bond in the form of a mortgage bond was born, which actually turned out to be a new financial product which were bought in and sold by the investment bank, the likes of which include the Goldman Sachs, Merrill Lynch, Bear Stearns, and Morgan Stanley. The mortgage bond basically takes thousands of home mortgages which were purchased from lenders to bundle their income source, which majorly were the monthly mortgage payment, into a single financial product, which later are bought and sold as bonds. Such bonds, though, have a couple and later on crippling problems based on the concept that the homeowners most often refinance their own debt during periods of low interest rates so as to prematurely repay the principal.
In order to address this concern, what Wall Street did was to structure these separate mortgage bonds into stacked layers, which were called the tranches, with the lowest layer representing the first end mortgages to be paid off early and the topmost layer being the last end mortgages. Investors which were seeking higher and higher returns on their money while accepting more and more risk could now invest in these lower tranches, and those wishing lesser return with lower risk would instead invest in the higher tranches.
The major Wall Street firms by this time started to use the subprime mortgages to create mortgage bonds. These mortgage bonds were the mortgages having a higher risk whilst paying even higher interest rates, and were made to the debtors having lower levels of credit. These structural tranches of the mortgage bond, which were built from the subprime mortgages at this point, basically signified not only prepayment but also the absolute default. With the increasing demand from the Wall Street to buy subprime mortgages, lenders were encouraged to place even more subprime loans, since they were no longer at risk if the loans failed, and began to push messages like refinance your home, unlock all that equity, pay off your credit card debt, and go on vacation. Often, these lenders swayed those without credit and who cannot afford a mortgage at all to get one, nevertheless. To induce these customers, a new type of mortgage was created, a variable rate one, which had extremely low initial interest rates and which were later reset to higher levels.
These mortgages were grabbed en masse, not comprehending that the real estate bubble materializing around them was actually driven by their own action. Since the underlying mortgages degraded in terms of quality, the Wall Street mortgage bonds started to become naturally riskier, which common sense dictates out to mark them much more challenging and sell to investors. Why? Since the buyers of Wall Street products look upon the rating agencies, specifically Moody's and Standard & Poor's, for assistance through these ratings by the agencies, the riskier the product is, the lower rating they are given. These rating agencies and the Wall Street have fundamental conflict of interest. This is visible through the fact that the Wall Street is the one who pays these agencies to rate the investment. This conflict leads these rating agencies to rate these high-risk mortgage bonds sky-high rating. The agencies would now use the models delivered to them by the Wall Street and rate the mortgage bond based on the average credit score, FICO score, of the borrower. The Wall Street started to structure the bond containing both the high and low FICO borrowers, which then increased the overall bond rating.
We would need to get into a bit of information revolving around the FICO score. A FICO score is a type of credit score created by the Fair Isaac Corporation. Lenders use borrowers' FICO score along with other details on borrowers' credit report to assess credit risk and determine whether to extend credit. FICO scores consider various factors in 5 areas to determine credit worthiness. payment history, the current levels of indebtedness, types of credit used, length of credit history, and new credit account. FICO scores range between 300 and 850. In general, scores above 650 indicate a very good credit history. In contrast, individuals with scores below 620 often find it difficult to obtain financing at favorable rates. The fact that the solvency of a bond, which would compose of 10 borrowers having the scores of 680, would be dramatically different to the one with 5 of them having 700 and 5 with 670 never occurred to the rating agencies, since for the bond to fail, only a relatively smaller percentage of the total mortgages would need to default. For my Indian viewers, a direct comparison to the FICO score would be the CIBIL score in India.
Despite the boom in mortgage bonds, Wall Street's desire for ever more profits grew stronger, led them to focus on relatively lower ratings of the bottom, which are the riskiest, tranches of the mortgage bond. They came up with a clever idea. They could package the bottom tranches of hundreds of different mortgage bonds together, and then on the principle of diversification, perhaps they could convince Moody's and S&P to give higher ratings to the collective as a whole.
That is exactly what happened, and the collateralized debt obligation (CDO) was born. What in retrospect seemed unthinkable, the rating agencies gave CDOs a rating of AAA, communicating a risk rating equivalent to US Treasuries. This was based on the premise that if one group of Americans began to default on their mortgages, it would be unlikely that other group would. Just think about that.
Come 2007, the mortgage market started to dry up and the home prices started to stop inflating. While all the defaults were already scaling up, the Wall Street chose to have a blind eye towards the obvious. They continued to be still focused on the sales concerning the CDOs. But now, since the source of mortgages were falling down as mentioned previously, they had to collect something else to pack in those CDOs. They found the answer lying within the credit default swaps, which were their income stream. The bank themselves started to see the credit default swap and started to package the income stream from them in the form of the insurance premium into those CDOs. The investment bank by 2008 were making obscene volumes of revenue, but there was a sizable amount of CDOs and mortgage bonds awaiting to be sold. These also were on the liability side of the credit default swap, which were already colossal in number and majorly sold and traded in between themselves. AIG's liability end with the credit default swap could lead to billions of dollars. The pension fund around the world, even with European countries having invested in them, had large-scale investment on the CDOs and the mortgage bonds. And then it all collapsed down.
The signs were everywhere, but now it's official, we are in a recession. Wall Street is clearly worried. The Dow plunged nearly 680 points today, or 7.7%.
It all started with the dropping down of the real estate prices. The Americans started to default en masse on their mortgages. The investment banks started to check up on their losses on their CDOs and mortgage bonds. But it was already too late, and it also led to the collapsing down of the credit default swap being hedged. Bear Stearns started to fear insolvency, and once those reports surfaced, their stock crashed, which in turn triggered the same for other financial firms. The government intervened with helping the Lehman Brothers to go bankrupt while triggering even more panic in the market, leading to the freezing of commercial lending and paralyzing the business in America and thus all over the globe, like a domino effect. Many Americans and a significant number of Europeans lost their jobs, savings, and retirement funds. The US government, in order to save the faces of AIG and other world's largest financial firms from the collapse, bailed them out, paid off their debts, and assumed their liabilities, which placed this burden onto the rest of American people, which most likely would still have an effect for generations to come.
And that is the story of how the economy collapsed in 2008. And just like always, the way capitalism has always worked, the bank owners and the executives of all these major Wall Street firms went home with billions of dollars of the taxpayers' money in their wallets in the form of cash bonuses, while those middle-class taxpayers faced the brunt of the same. Thank you for tuning in. See you in the next episode.